Hello everyone, welcome back to my channel. In today's video, we'll be looking at financial instruments, debt instruments, practice questions. If you haven't watched my previous video about financial assets, debt instruments, kindly do so to get more light on what we've done so far, because we'll be applying certain principles we established in the previous video based on the IFRS and IAS standards in solving this practice question. So to get a brighter view, kindly do so by watching the previous video on debt instruments. So let's run into the question. Alright, so we'll be starting with number 1, question 1. Agate Limited. Alright, so let's look at what the question says. Question 1. Agate Limited purchased 10% debentures of face value 100,000 issued by Adom Limited for 99,500 on January 1st, 2006. The debenture will pay an annual coupon every December 31st and be repaid after 5 years at 100,100 Ghana cedis. Agate Limited incurred transaction cost of 200 cedis and the effective interest rate is 10.10%. The entity intends to hold these investments to maturity. Required: show how the transaction will be presented in the books of Agate Limited. Okay, so this is a typical examinable question, whether ICA or quiz or terminal exams. So we are going to break it down into the simplest form to get a deeper understanding of what the question means by show how the transaction will be presented in the books of Agate Limited. So we can start by giving a summary of this question, what it entails and what it covers, which part of the standard we are going to use or we are going to need in solving this question. So first and foremost, we need to identify what this financial instrument is. Alright, so I think our first statement or first sentence will help us identify which financial instrument is, whether it's a financial asset or financial liability. But since we are dealing with financial assets, our questions are targeted to financial assets. But the first clue here is purchased. So Agate Limited purchased 10% debenture of face value 100,000 issued by Adom Limited. And let's also take note that we are reporting in Agate Limited's book. So if Agate Limited purchased 10% debenture of face value 100,000 Ghana cedis issued by Adom Limited, which means that Agate Limited has acquired a financial asset. Agate Limited has acquired a financial asset. Right. So we could see that the financial asset value is 100,000 cedis issued by Adom Limited or bought by Agate Limited, but it was issued for, or it was bought for 99,500 Ghana cedis, which means that it was bought at a discount of the difference. So the difference between 100,000 and 99,500 is 500, which means that Adom Limited discounted the financial asset to Agate Limited. Right. So the debenture will pay an annual coupon. So the annual coupon here is the annuity Is that okay? So the annual coupon here is the annuity or the fixed equal payment that will be made every year. That will be paid every year to Agate Limited, because Agate Limited has acquired, so he has the right of entitlement to a regular amount of cash flow. Alright, so the coupon here is the 10%. The coupon in the question is the 10%. Always, let's take note of that. It's always the rate that immediately follows the financial asset or liability, and be repaid after 5 years at 100,100. So we could see that the face value is 100,000, but it is being paid at a value. It will be repaid at the end of the year, or it will be redeemed at 100,100, which means that it will be redeemed at a premium. Here the premium is 100. The premium has already been calculated, but in some other questions we may be required to calculate the premium and add it to it. And they said Agate Limited incurred transaction cost of 200 cedis, and the effective interest rate is 10.10%. So the effective interest rate here is the rate that helps or shows how the financial asset will mature over time. The financial asset will mature over time. So that is the rate that causes the assets to mature over time. So in this question, it will mature before payment is made, which means payment is made in arrears. That's why we have here the debenture will be paid a coupon, where the coupon will be paid every December 31st. Is that okay? And then the entity intends to hold this investment to maturity. So let's remember the cash flow characteristics test and the business model test. So the business model test here, Agate Limited intends to hold to maturity, which means we are going to amortize. We are not going to fair value through other comprehensive income. Is that okay? So the entity intends to hold to maturity. So the entity doesn't have any intention to sell if the opportunity comes. Alright. Okay. So we have explained every item in the question. Comment down below if we didn't tackle any aspect of this question. If we didn't explain it to your satisfaction, please let me know in the comment section. Alright, so let's move to our working sheet and let's see how we are going to present this in the statement of income and statement of financial position, and also pass some journals to reflect the initial or the inception measurement. Okay, so we realize that the financial asset was acquired at 99,500 Ghana cedis at inception. So it was being discounted for Agate Limited. So at inception, the initial recognition of the financial asset will be that Agate Limited bought a financial asset, which is a debenture, at a price of 99,500. So at inception, we are going to debit financial assets. Inception, we are going to debit financial assets and credit cash, because cash or bank, Agate Limited will be paying out of cash or bank. So we are going to debit financial assets. I'm going to debit financial assets. Financial assets is cash or bank. No credit cash or bank. No credit cash or bank. The same value at 99,500. So we need to make a narration. So being financial asset acquired. So being gain something small, gain financial asset, which is we are good to go. Then we could see there was a transaction cost also incurred. As we already know, the standard requires us that financial assets, when acquired, we need to add the transaction cost to it. For financial assets that are to be amortized, we need to add the transaction cost to the value of the financial assets. So we are going to pass a journal to recognize the expense as well. So with the expense, we debit financial assets. So we debit financial assets. Financial assets. Venture. With the value of the expense. The value of the expense, which is 200 Ghana cedis. So let's check it out here. It is 200 Ghana cedis. So 200 Ghana cedis. 200 cedis. And then we credit cash, probably cash or bank. Okay, so cash or bank. So kindly try the narration and let me see. You can comment it down below. Let me see different varieties of how you are going to give narration to the transaction cost. So here we pass a journal to recognize our financial assets at inception. So at inception, the value of our financial assets will be 99,700. So let's make a quick review. So the face value of the asset itself is 100,000, but it was sold to Icag Limited, or Icag Limited bought it at 99,500, which means it was discounted. And also we incurred a transaction cost. Icag Limited incurred transaction cost. So since it's a financial asset that is to be amortized, or where the intention of Icag Limited is to hold to maturity, we have to capitalize it 200. We are not going to expense it, capitalize it. And in doing so, we debit the financial assets and credit our cash. So at the end of 1st January, we are going to have 99,700 as the value of the financial assets. So we can also make a T account here. So in the T account, we are going to debit financial assets in the name of cash or bank, using the same amount, that 99,500, and also debit financial assets again with the transaction cost to cash or bank. Now transaction cost TC, so we can name it TC. Okay, so we are going to have 200, right? And in order to balance this account, we are going to have a balance carried down here, of the total, that's 99,700. So we are basically balancing it. So we are going to have a balance brought down here, of 99,700, which means that at inception, this value here is going to be the value we are going to report here at the beginning in the amortization schedule. So we are going to use this value here. So I decided to make a journal entry and also pass a double entry also to reflect the transaction to get a brighter view. I hope that's simple. Comment down below, let me know your reaction to how I did it. So we are going to, the opening balance will be the summation of the value of the financial asset and also the transaction cost. So at inception or at the beginning, we are going to have 99,700 as the value of our financial assets, and we are going to charge the effective interest rate. So here we are told that the coupon, so let's go back to the question. So we are told that the debenture will pay an annual coupon of what? An annual coupon at the end of the year, which is the 10% on the face value. Let's bear in mind the 10% coupon is always on the face value. It's not on the discounted value. It's on the face value. Alright, so 10% on 100,000 is 10,000. But the effective interest rate is charged at the opening balance, on the opening balance of the financial asset. Let's bear in mind, since the payment of the coupon is in arrears, the financial asset will grow before the coupon is paid. That is why we have the interest rate coming first before the payment. So the interest rate is going to be 0.101 times 99,700. Let's try and round our figures to the nearest whole number. So we are going to have 10,070. Actually, the figure is 10,069.7. So we just round it to the nearest whole number. That's 10,070, right? And our coupon is 10,000 throughout. So we are going to pay 10,000 every year until the last year, right? So at the end of the first year, we are having 99,770 as the closing balance of the financial asset. So if you haven't watched the breakdown of the amortization schedule I did in my previous video, kindly do so, because I explained what the amortization schedule entails. So at the beginning of the financial asset or of the amortization schedule, we are going to have 99,700, and we charge interest rate of 10,000 and 70,000. That's the rate at which the financial asset is going. Then we make a coupon payment of 10,000. Then the summation of all these will give us 99,770. So the 99,770 becomes our closing balance at the end of year 1. So that becomes the opening balance in year 2. We are going to have 99,770. Then we charge interest, and if we charge interest of 10.10%, we are going to have 10,077. We're going to have 10,077, and we pay the coupon. We pay the coupon of 10,000. Pay the coupon of 10,000. So we are going to have 99,847 as our closing balance. So the same procedure follows. So that's what we are going to do. So 99,847. Then we charge interest of 10,000. We charge interest of 10.1%, but the actual figure is 10,080 and 85 and 85. Make sure you round your figure to the nearest whole number. So we are going to have this. Okay, I think there's a mistake here. Let's rectify it before we move on. So that's 99,847. So that has been solved. So we have the right figure. That's the opening figure is going to be 99,932. Then the interest rate is going to be 10,093. Then we pay the coupon of 10% on the face value, 10,000. Right? In the last year. So now let's pay attention here. In the last year, it becomes so confusing, but we will try and make it simple as possible here. Remember, in the last year, the entity is going to redeem the financial asset. The financial asset is going to be redeemed, and it won't exist in the entity's book again. So there shouldn't be any closing balance in year 5, because we wouldn't have any balance to report in the subsequent year, because the lifespan or the term of the financial asset is 5 years. So we shouldn't have any closing balance at the end of year 5. Alright. So at the beginning of year 5, we were having 100,025, right? And we have to redeem. So let's go back to our question. So we were told that it will be redeemed at 100,100, right? And that year to coupon will be paid. So the coupon, the redemption fee or the redemption amount, which is 100,100 plus the 10,000 coupon. All right, we are going to have 110,100 as our payment at the end of the 5th year. All right, so the 5th year we are going to pay 110. So to make your closing balance zero, you see I haven't placed any effective interest rate here. All right, but if you should calculate 10.1% on this figure, you should get a particular figure, which is 100,000, and you should get a value that's 10,102.5 0.5. So rounding it to the nearest whole number, I'm going to have 10,103 Ghana cedis. That should have been here. But if you should do everything, there would be a balance here. We don't want to create that. So what we are going to do is that you find the difference between this opening balance and this total payment. Then the difference between this and this is this. All right. So we put this figure. So in order not to have any closing balance at the end of the year 5, we are going to put this value here. All right. So that's 10,075. So we won't have any closing balance here to avoid any further. So instead of reporting 10,103 as effective interest rate, we'll report 10,075, not to have a balance here. So the standard hasn't really prescribed any form of doing it, but as we all know, we cannot put a figure there and to explain it as rounding errors and other stuff. So we need to find a way to make it there, and this is one of the ways to make it. All right. So we are almost through with this question, and the most important thing is what we are going to do now. So let's go back to the requirement of the question. The question said, let's look at the required. To show how the transaction will be reported in the books of Agate Limited. And the books of Agate Limited is statement of income and statement of financial position. Let's bear in mind the statement of income and statement of financial position. Statement of income and statement of financial position. So here we are going to present them here, right? So extract from statement. So we are going to extract a portion of the statement of profit or loss or statement of income. So the statement of income is going to have the effective interest rate. Okay. So since it's a financial asset, Agate Limited will be receiving this interest, right? So we are going to send interest received, okay, or finance income. Right? So the finance income will be the best. So finance income. So we are going to report For year 1, we're going to report 70,000 and 10,000 and 70. Sorry for that. Year 2 also, we're going to report the remaining, we are going to report it to correspond the year. 10,000. Okay, and we are also going to report in the statement of financial position the closing balances of the financial assets for the respective years. So financial assets, we are going to report financial assets. Venture. So at the end of the first year, we're having 99,700 and having 99. So at the end of the first year, we're having this figure, that is 99,770. At the end of year 2, we're having 99,847. At the end of the third year, we're having 99,932. At the end of the fourth year, we're having 100,029. So at the end of the fifth year, we are not going to report anything because by the end of each year, the financial assets should have been redeemed. So we are done. Thank you for watching. If you find this video useful, kindly give it a like and subscribe if you have. Thank you. See you in the next.